Hello and welcome to the second video in Chapter 9. I'd like to start with page 9.6. Okay. Alright, let's talk about a little bit about pensions and tips and backup withholding. Okay. When you get near retirement, alright, you may start drawing on an IRA that you had or a pension that you had with your company. And what the trust company or who's ever holding your pension money should do is send you a W4-P, okay, W4P, and ask you how you want to withhold. Now, on a federal tax return, pensions are treated the same as wages. Okay, so if you were, claiming single and one on your job before you retired, you should probably claim single and one on your pension. It just depends upon how big your pension is. All right, most people's pensions are not as large as their wages were. All right, so if you were making $60,000 a year on your job, and you're making $24,000 a year on your pension, okay, you may not have to have anything withheld because, again, if you're married filing jointly, your standard deduction rises to $24,000 in 2018, and that would completely cancel out any pension income you have. The problem is that a lot of people have both pension income and other types of income, like interest income or capital gains, and may even be drawing a pension while they are still working. All right, for example, they were in the military for over 20 years, so they're drawing a pension and they still have wages at a regular job. Okay, so what you generally would do is you would sit down, and you could do this at the IRS.gov website. My students could do this probably through the tax software that they're using. Most tax software comes with some kind of a program where you can figure out what should go on a W-4 form, whether it's a pension form or a regular wage W-4 form. But you need to withhold on a pension just as much as you would on your job. Okay, pension income is not free. All right. Some states do not tax pensions. For example, states that don't have an income tax don't tax pensions. Neither does Michigan. All right. Indiana, unfortunately, does tax pension income. They don't tax Social Security income, but they do tax pension income. Okay. All right. At the bottom of page 9.6 and top of page 9.7, they talk about tip reporting. Now, those of you that have ever had a tip job, you would be familiar with Form 4070, which is replicated at the top of page 9.7. This is a form that you would submit to your employer every month, all right, or every pay period, and the employer adds the amount of the tips to your wages, and then has federal income tax and Social Security tax, calculated on the entire amount. Employees know this, so a lot of times they'll underreport their tips deliberately so that they don't have a lot of federal and FICA tax coming out of their paycheck, which usually isn't very high anyways, because the minimum wage for a tipped employee is between $2 and $3 an hour. All right, because the employer expects the employee to earn the rest of the wages through tips to equal the minimum wage. Because of that, the IRS sets a minimum 8% rule. So what the employer does at the end of the year is they take their gross receipts for the year times 8%, and then they compare that to all of the tips that were reported on Form 4070 by all the employees. And if the total of those forms doesn't equal 8% of the gross receipts, then the employer has to allocate tips among all the employees that work for that employer during the year. In my 30 years of doing taxes, I've only seen that happen twice. All right, one, because most employees are fairly honest, and two, an 8% tip is usually not very large. All right, and again, the IRS knows that. The 8%, they probably figure employees report about half of their tips, and they figure the average tip per the employee then is 16%. But that's how that works. Okay, all right. And then you have something at the bottom of page 9-7 and top of page 9-8, something called backup withholding. Okay, now where I see this the most often is, for example, I would have a client who would hire like one of their tenants to work for them, or they would hire just somebody to do a job once in a while. And if you anticipate paying that person more than $600 a year, all right, you should have them fill out a form W-9, okay, W-9. And what the person does when they fill that form out is they are saying that they are not subject to backup withholding. So if you pay somebody as an independent contractor, all right, not as an employee, but as an independent contractor, and you do not receive the W-9 form from them, then what you're supposed to do is you are supposed to withhold 28% of the amount that you would normally pay them and send that 28% to the U.S. Treasury on their behalf. So, for example, you hired somebody as a subcontractor and you paid them $1,000. All right. If they gave you the W-9 form, you would give them a check for $1,000. If they didn't give you the W-9 form, you would give them a check for $720, all right, or 72%, and you would send the other 28% to the IRS on their behalf. And then at the end of the year, you would send them a 1099, and you would show the amount of federal income tax withheld on their behalf. Most subcontractors that I know can't afford to have 28% sent to the IRS as backup withholding, and so they know that they will have to fill out a W-9 and give it to you. Once you get the W-9, you're off the hook. Whether they report the amount you paid them on their tax return is totally up to you, or up to them. Okay, so again, just if you go into business, all right, and you are going to hire subcontractors who are not incorporated, that's the other thing. All right, if you hire somebody and, for example, you get into contracting and you hire somebody to do drywall, just ask for their W-9. If they're incorporated, they are automatically exempt from backup withholding. All right, if they and you would not need a W-9 on file from them. All right, but if they are not incorporated, you have to have a W-9 form on file. All right, because again, you could be audited. And remember that all companies generally are audited once a year by their insurance companies, and those insurance companies will be looking for those forms. Okay, all right. So that takes care of that, and then we'll talk about estimated payments in the next video.